by others here. We admire immensely your willingness to serve our country, and it goes for all of you here at the table. There are obviously concerns that have been expressed here strongly this morning. I hope it's been valuable for you to hear from across the country how our colleagues are hearing from their constituents and their own concerns about these issues. In no way should this be an interpretation of our lack of respect and admiration for those willing to serve our country. And we appreciate immensely your willingness to do it. We admire as well your background and experience you bring to this issue. So with that, we thank you for being here this morning, anxious to receive your testimony and answer some questions.
Thank you very much, Chairman Dodd, Senator Shelby, members of the committee. Thank you very much for the opportunity to appear before you today. I very much appreciate the comments you made, and I understand them and I appreciate them. I also share the comments that you all made about the importance of this situation and the importance of this hearing. This is a difficult period for the American people. I very much appreciate the fact that congressional leaders and the administration are working closely together so that we can help the American people by quickly enacting a program to stabilize our financial system. We must do so in order to avoid a continuing series of financial institution failures and frozen credit markets that threaten American families' financial well-being, the viability of businesses both small and large, and the very health of our economy. The events leading us here began many years ago, starting with bad lending practices by banks and financial institutions and by borrowers taking out mortgages they couldn't afford. We've seen the results on homeowners, higher foreclosure rates affecting individuals and neighborhoods, and now we're seeing the impact on financial institutions. These loans have created a chain reaction, and last week's our credit markets froze. Even some Main Street non-financial institutions, some non-financial companies had trouble financing their normal business operations. If that situation were to persist, it would threaten all parts of our economy. Every American business depends on money flowing through our system every day, not only to expand their business and create jobs, but to maintain normal business operations and to sustain jobs. As we've worked through this period of market turmoil, we've acted on a case-by-case basis, addressing problems at Fannie Mae and Freddie Mac, working with market participants to prepare for the failure of Lehman Brothers, and lending to AIG so it can sell some of its assets in an orderly manner. And here I would make the comment, I've heard your comments on executive compensation. I share your frustrations. I feel those frustrations. Practices throughout America also upset me. Let me just say that with regard to Freddie and Fannie and AIG, in case you or your constituents don't know, in those cases, CEOs were replaced. The government got warrants for 79.9% of the equity. Golden parachutes were eliminated. Strong action was taken. I will also say to the comments made about Freddie and Fannie and the bazooka, you all can be darn glad you gave us the bazooka because we needed it. Let me tell you something. The root of that problem was in congressional charters started many, many years ago. We were living up to our obligations here. There were ambiguities. There were obligations around those charters. And what we did was we came in, we stabilized the market, mortgage rates went down so that capital could flow through our system. And I can just say, I for one, and I know that the other witnesses feel very glad about this, thank goodness that was done and they were stabilized before we had some investment banks report their earnings. Or let me tell you, this would be a much more serious situation than it is today. So there was an example of broad authorities working the way they were supposed to work to stabilize our system. Now, sorry for that ad hoc response, but we've also taken a number of powerful tactical steps to increase confidence in the system, including a temporary guarantee program for the U.S. money market mutual fund industry. These steps have been necessary but not sufficient. More is needed. We saw market turmoil reach a new level last week and spill over into the rest of the economy. We must now take further decisive action to fundamentally and comprehensively address the root cause of this turmoil. And the root cause is a housing correction, as you've all pointed out, which has resulted in illiquid mortgage assets that are choking off the flow of credit, which is so vitally important to our economy. We must address this problem and this underlying problem and restore confidence in our financial markets and financial institutions so they can perform their mission of supporting future prosperity and growth. We have proposed a program to remove troubled assets from the system. We would do this through market mechanisms available to thousands of financial institutions throughout America. Big banks, small banks, savings and loans, credit unions, to help set values of complex, illiquid mortgage and mortgage-related securities, to unclog our credit and capital markets and make it easier for private investors to purchase these securities and for the financial institutions to raise more capital after the market learns more about the underlying value of these hard-to-value, complicated, mortgage-related securities on their balance sheets. This troubled asset relief program has to be properly designed for immediate implementation and be sufficiently large to have maximum impact and restore market confidence. It must also protect the taxpayer to the maximum extent possible and include provisions that ensure transparency and oversight while also ensuring the program can be implemented quickly and effectively. And let me give you another ad hoc comment there. When we all met Thursday night, as you'll recall, Chairman, with the leaders of Congress, you all said to us, don't give us a fait accompli. Come in and work with us. We gave you a simple 3-page legislative outline, and I thought it would have been presumptuous for us on that outline to come up with an oversight mechanism. That's the role of Congress. That's something we're going to work on together. So if any of you felt that I didn't believe that we needed oversight, I believe we need oversight. We need oversight. We need protection. We need transparency. I want it. We all want it. And we need to do that in a way that lets this system, let this program work effectively, quickly, because it needs to work effectively and quickly, and it needs to get the job done. Now, the market turmoil we are experiencing today poses great risk to U.S. taxpayers. When the financial system doesn't work as it should, Americans' personal savings and the abilities of consumers and businesses to finance spending, investment, and job creation are threatened. The ultimate taxpayer protection will be the market stability provided as we remove the troubled assets from our financial system. Don't forget that. If this system has to work and has to work right, and that will be the ultimate market protection. I am convinced that this bold approach will cost American families far less than the alternative, a continuing series of financial institution failures and frozen credit markets unable to fund everyday needs and economic expansion. Again, I'm frustrated. The taxpayer is on the hook. The taxpayer is already on the hook. The taxpayer already is going to suffer the consequences if things don't work the way they should work. And so the best protection for the taxpayer, and the first protection for the taxpayer, is to have this work. Over these past days, it has become clear that there is a bipartisan consensus for an urgent legislative solution. We need to build upon this spirit and enact this bill quickly and cleanly, and avoid slowing it down with provisions that are unrelated or don't have broad support. This troubled asset purchase program on its own is the single most effective thing we can do to help homeowners, the American people, and to stimulate our economy. Earlier this year, Congress and the administration came together quickly and effectively to enact a stimulus package that has helped hardworking Americans and boosted our economy. We acted cooperatively and faster than anyone thought possible. Today, we face a much more challenging situation that requires bipartisan discipline and urgency. When we get through this difficult period, which we will, Our next task must be to address the problems in our financial system through something you've all talked about. We need reform that fixes this outdated financial regulatory structure. You've all heard me talk about that a lot. And we need other strong measures to address other flaws and excesses in the system. And there are plenty. And we've all talked about them, and they can't be addressed this week. We need to take time to address these. I've already put forward my recommendations on this subject. Many of you have strong views based on your expertise. We must have that critical debate, but we must get through this period first. Right now, all of us are focused on the immediate need to stabilize our financial system. And I believe we share the conviction that this is in the best interest of all Americans. Now let's work together to get it done. Thank you.
Thank you very much, Mr. Secretary. I'd be remiss if I didn't just point out, and thank you, by the way, but for the cooperation of Senator Shelby and the overwhelming majority of members of this committee, we were able to enact that legislation in July that you've referenced. And doesn't mean that everybody was supportive of every detail of it, but it was an example of coming together and getting a job done. It took some time, but we got it done. And I thank you for your comments about it, and I thank Senator Shelby and members of this committee, Democrats and Republicans, who worked with us to get that done. Chairman Bernanke.
Mr. Chairman, Senator Shelby, I have submitted formal written testimony for the record. With your permission, I'd like to speak just a few minutes about the Treasury proposal. The Fed supports the Treasury initiative. We believe that strong and timely action is urgently needed to stabilize our markets and our economy. But I believe some clarification is needed about why this proposal could make a positive difference, and I'd like to offer a few thoughts on that subject. Let me start with the question: why are financial markets not working? Financial institutions and others hold billions in complex securities, including many that are mortgage-related. I'd like to ask you for a moment to think of these securities as having two different prices. The first of these is the fire sale price. That's the price a security would fetch today if sold quickly into an illiquid market. The second price is the hold-to-maturity price. That's what the security would be worth eventually when the income from the security was received over time. Because of the complexity of these securities and the serious uncertainties about the economy and the housing market, there is no active market for many of these securities. And thus, today, the fire sale price may be much less than the hold-to-maturity price. This creates something of a vicious circle. Accounting rules require banks to value many assets at something close to a very low fire sale price rather than the hold-to-maturity price, which is not unreasonable in itself given their illiquidity. However, this leads to big write-downs and reductions in capital, which in turn forces additional sales that send the fire sale price down further, adding to pressure. Meanwhile, private capital is unwilling to come in because of uncertainty about the value of institutions and because of the prospect of more write-downs. One suggestion that's been made is to suspend mark-to-market accounting and use banks' estimates of hold-to-maturity prices. Many banks support this. But doing this would only hurt investor confidence because nobody knows what the true hold-to-maturity price is. Without a market to determine that price, investors would have to trust the internal estimates of banks. So let me come to the critical point. I believe that under the Treasury program, auctions and other mechanisms could be designed that will give the market good information on what the hold-to-maturity price is for a large class of mortgage-related assets. If the Treasury bids for and then buys assets at a price close to the hold-to-maturity price, there will be substantial benefits. First, banks will have a basis for valuing those assets and will not have to use fire sale prices. Their capital will not be unreasonably marked down. Second, liquidity should begin to come back to these markets. Third, removal of these assets from balance sheets and better information on value should reduce uncertainty and allow the banks to attract new private capital. Fourth, credit markets should start to unfreeze. New credit will become available to support our economy. And fifth, taxpayers should own assets at prices close to hold-to-maturity values, which minimizes their risk. Now, how to make this work? To make this work, we do need flexibility in design of mechanisms for buying assets and from whom to buy. We do not know exactly what the best design is. That will require consultation with experts and experience with alternative approaches. Second, understanding the concerns and the worries of the committee, we cannot impose punitive measures on the institutions that choose to sell assets. That would eliminate or strongly reduce participation and cause the program to fail. Remember, the beneficiaries of this program are not just those who sell the asset, but all market participants and the economy as a whole. But finally, and very importantly, this is not to say that the financial industry should not be reformed. It should be. It's critical. I agree with the Treasury Secretary. The Federal Reserve will give full support to fundamental reform of the financial industry. But whatever reforms the Congress makes should apply to the whole industry, whether they participate in this program or not. So in summary, I believe that under the Treasury authority being requested, a program can be undertaken that will help establish reasonable hold-to-maturity prices for these assets. Doing that will restore confidence and liquidity to financial markets and help the economy recover without an unreasonable fiscal burden on taxpayers. So I urge you to act as soon as possible. Thank you.
Thank you, Mr. Chairman, for that testimony. Christopher Cox.
Thank you, Chairman Dodd, Ranking Member Shelby, members of the committee, for inviting me here today to discuss the current turmoil in our markets and our policy responses to it. The extraordinary nature of recent events has required an extraordinary response from both policymakers and regulators. Last week, by unanimous decision of the Commission, and with the support of the Secretary of the Treasury and the Federal Reserve, as well as close coordination with regulators around the world, the SEC took emergency action to ban short selling in financial securities to stabilize markets as you consider this legislation. At the same time, the Commission unanimously approved 2 additional measures to ease the crisis of confidence in the markets. One makes it easier for issuers to repurchase their own shares on the open market, thus providing additional liquidity. The second requires weekly reporting to the Securities and Exchange Commission by large investment managers of their daily short positions. In addition, the SEC recently issued new rules that more strictly enforce the ban on abusive naked short selling under our regulation show. Beyond these immediate steps, the SEC is vigorously investigating how illegal activities may have contributed to this subprime crisis and the recent instability in our markets. First and foremost, the SEC is a law enforcement agency, and we already have over 50 ongoing investigations in the subprime area alone. The Division of Enforcement has undertaken a sweeping investigation into market manipulation of financial institutions, including through the use of credit default swaps, a multi-trillion-dollar market which is completely lacking in transparency and is completely unregulated. Last month, the Enforcement Division, working with state regulators, entered into agreements that will be the largest settlements in SEC history in behalf of investors who bought auction-rate securities from Merrill Lynch, Wachovia, UBS, and Citigroup. Happily, the terms of these agreements would provide complete recovery for individual investors. The Commission also recently brought enforcement actions against portfolio managers at Bear Stearns Asset Management for deceiving investors about the hedge fund's overexposure to subprime mortgages. The Commission is using its regulatory authority simultaneously to ensure that the market continues to function. Last week, the Commission's Office of Chief Accountant provided guidance to clarify the accounting treatment of banks' efforts to support their money market mutual funds. This will help protect investors in those funds. And our examinations of the major credit rating agencies for mortgage-backed securities exposed weaknesses in their ratings processes and led to our sweeping new rules to regulate this industry under the new authority that this committee and the Congress have given us. We are also moving quickly to mitigate the impact of recent events. In the past week, the SEC oversaw the sale of substantially all of the assets of Lehman Brothers Incorporated to Barclays Capital. Hundreds of thousands of Lehman's customer accounts with over $1 billion in assets can now be transferred in a matter of days, instead of going through a lengthy brokerage liquidation process. With all that has happened, it is important to keep in mind how we got here. The problems that each of these actions has addressed have their roots in the subprime mortgage crisis, which itself was caused by a failure of lending standards. The complete and total mortgage market meltdown that led to the taxpayer rescue of Fannie Mae and Freddie Mac was not built in to the stress scenarios and the capital and liquidity standards of any financial institution. Bank risk models in every regulated sector, for better or for worse, failed to incorporate this scenario that has caused so much damage in financial services firms of all kinds. The SEC's own program of voluntary supervision for investment bank holding companies, the Consolidated Supervised Entity Program put in place in 2004, was fundamentally flawed because it adopted these same bank capital and liquidity standards and because it was purely voluntary. It became abundantly clear with the near collapse of Bear Stearns that this sort of voluntary regulation doesn't work. Working with the Federal Reserve, the Division of Trading and Markets moved quickly last spring to strengthen capital and liquidity at investment bank holding companies far beyond what the banking standards require. And we immediately entered into a formal memorandum of understanding with the Fed to share both information and expertise. But the fact remains that no law authorizes the SEC to supervise investment bank holding companies, let alone to monitor the broader financial system for risk. For the moment, this regulatory hole in the statutory scheme is being addressed in the market by the conversion of investment banks to bank holding companies. But the basic problem must still be addressed in statute by filling that regulatory hole, as I've reported to Congress on previous occasions. I will conclude, Mr. Chairman, by warning of another similar regulatory hole in statute that must immediately be addressed or we will have similar consequences. The $58 trillion notional market in credit default swaps, to which several of you have referred in your opening comments, that is double the amount that was outstanding in 2006, is regulated by absolutely no one. Neither the SEC nor any regulator has authority over the CDS market, even to require minimum disclosure to the market. This market is ripe for fraud and manipulation, and indeed we are using the full extent of our anti-fraud authority, our law enforcement authority, right now to investigate this market. Because CDS buyers don't have to own the bond or the debt instrument upon which the contract is based, they can effectively naked short the debt of companies without any restriction, potentially causing market disruption and destabilizing the companies themselves. As the Congress considers reform of the financial system in the current crisis, I urge you to provide in statute for regulatory authority over the CDS market. This is vitally important to enhance investor protection and to ensure the continued operation of fair and orderly markets. Mr. Chairman, I appreciate the opportunity to discuss this current market turmoil, and I look forward to answering your questions.
Yeah. Well, thank you, Mr. Chairman. Let me just very briefly, we received your testimony about 20 minutes before the hearing began today. Other chairmen over the years have talked about it, and again, I'll just raise it briefly here with you. We need to get the testimony, and I appreciate the fact we did from other witnesses last evening. We need to get it from the SEC earlier than 20 minutes before a hearing. Mr. Lockhart.
Chairman Dodd, Senator Shelby, and members of the committee, thank you for the opportunity to testify on the Federal Housing Finance Agency's decision to place Fannie Mae and Freddie Mac into conservatorship. Fannie Mae and Freddie Mac share the critical mission of providing stability, liquidity, and affordable to the nation's housing market. Between them, these enterprises have $5.3 trillion of guaranteed mortgage-backed securities and debt outstanding, which is equal to the total debt of publicly held debt of the United States. Their market share earlier this year reached 80% of all new mortgages made. During the turmoil that started last year, they had played a very important role in providing liquidity to the conforming mortgage market. They required capital to support a very careful and delicate balance between safety and soundness and mission. That balance was upset as house prices, earnings, and capital have continued to deteriorate. In particular, the capacity to raise capital without Treasury Department support vanished. That left both enterprises unable to fulfill their mission. Worse, it threatened to further damage the mortgage and housing markets if they had to sell their assets. Rather than letting those conditions worsen and put the financial markets in further jeopardy, FHFA decided to take action. The goal of these dual conservatorships is to help restore confidence in Fannie Mae and Freddie Mac, enhance their capacity to fulfill their mission, reduce systemic risk, and make mortgages, and this is the most important, make mortgages available at lower cost for the American people. FHFA based its determination on 5 key areas, each of which worsened significantly over the last several months. First, there was accelerating safety and soundness weaknesses. Second, there was a continued and substantial deterioration in equity, debt, and MBS market conditions. Third, the current and projected financial performance and condition of each company as reflected in its second quarter financial reports and our ongoing examination. Fourth, the inability of the companies to raise capital or to issue debt according to normal practices and prices. And lastly, the critical importance of each company in supporting the country's residential mortgage market. I shared our growing concern with Federal Reserve Chairman Bernanke, who was made our consultant in the law you passed in July, and with Secretary Paulson. They agreed that a conservatorship was necessary, as did the boards of both firms. A detailed list of events leading to our conclusion to appoint a conservator is provided in my written statement. I'll just highlight a few. It became apparent during this intense supervisory review that began in July that market conditions were deteriorating much more rapidly than anybody expected. We supplemented our examination team with senior examiners from the Fed and OCC. All three sets of examiners corroborated that there was a significant deterioration in the credit environment, and it was a threat to the capital of these two companies. We also finished our semi-annual examination ratings of the companies, and across the board, the ratings were significant and critical weaknesses. The companies themselves disclosed in their second quarter filings how rapidly the environment had deteriorated and was negatively affecting their outlook and their ability to raise capital. Freddie Mac reported losses of $4.7 billion over the last year. Fannie Mae reported losses of $9.7 billion. Now let me turn to the conservatorships. First signs are that the conservatorships are positive. The enterprise funding costs and the spreads on NBS have declined. This lower cost has been passed on to home buyers, with 30-year mortgage rates well below 6% for the first time since January. On the first day, business opened as normal, but with stronger backing for the holders of their mortgage-backed securities, their debt, and their subordinated debt. Over the next 15 months, they will be allowed to increase their portfolios to provide support to the housing market. They will also be able to continue to grow their guaranteed MBS books. As the conservator, FHFA assumed the power of the board and management. Highly qualified new chief executive officers and non-executive chairmen have been appointed. They will be delegated significant powers. In order to conserve over $2 billion in annual capital, the common stock and preferred dividends were eliminated. The U.S. Treasury financing facilities, which were critical to this conservatorship, are all in place and will provide the needed support to Fannie Mae and Freddie Mac to fulfill their mission over the long term while giving the upside potential for taxpayers. FHA will continue to work expeditiously on the many regulations needed to implement the new law. The new legislation adds, importantly, affordable housing, a trust fund, and mission enforcement to the responsibilities of the safety and soundness regulator. We are also continuing to work with the enterprises on loan modifications, foreclosure preventions, pricing, and credit issues. The decision to appoint a conservator for each enterprise was a tough but necessary one. They can now become part of the solution. Unfortunately, all the good and hard work put in by the FHFA and the enterprises was not sufficient to offset the consequences of the antiquated regulatory structure, which was overwhelmed by the turmoil in the housing markets. Conservatorship will give the enterprises the time to restore the balances between safety and soundness and their mission. Working together with the enterprises, Congress, and the administration and other regulators, I believe we can restore confidence in the enterprises, and with the new legislation which you passed, build a stronger and safer future for the mortgage markets, homeowners, and renters in America. Thank you. I'd be pleased to answer questions.
Thank you very much, Mr. Lockhart. Senator Tester was presiding over the Senate when we were gathering here.